For months now, one question has been everywhere on social media, in news headlines, and in everyday conversations across America. Is the housing market about to crash? People see high interest rates, expensive homes, rising costs of living, and they naturally assume something has to break. Historically, when affordability gets this stretched, prices usually fall. And yet the collapse everyone has been waiting for still hasn't happened. Today, we're going to break down what's really happening behind the scenes of the U.S. housing market, why certain policy moves are changing the direction of housing, and most importantly, why home prices may stay high longer than most people expect. Let's start with the fear because it's real. Homebuyers feel locked out. Renters feel stuck. Sellers feel uncertain. Interest rates jumped faster than they have in decades. Monthly mortgage payments exploded. And suddenly the American dream of owning a home started to feel unreachable for millions. In past cycles, this kind of pressure usually leads to falling prices. That's why so many people believe a crash is inevitable. But the problem with that assumption is simple: this housing market is not behaving like past cycles, and that's where most predictions go wrong. On paper, the crash argument sounds logical. Rates are high, affordability is near historic lows, and household budgets are stretched. When demand weakens, prices are supposed to fall. That's basic economics. Analysts look at charts, compare today to 2008 or earlier downturns, and assume history will repeat itself. But housing is not just about interest rates and demand. It's also about supply, and right now, supply is where the entire equation breaks. The biggest reason housing prices refuse to fall is painfully simple: there aren't enough homes. The United States has been underbuilding for over a decade. After the last housing crisis, construction slowed dramatically, regulations increased, labor costs rose, and building never caught up with population growth. Even today, the number of available homes for sale remains far below what a healthy market would need. When supply is tight, prices don't collapse even when buyers struggle. Another massive factor most people ignore is something known as the lock-in effect. Millions of homeowners bought or refinanced when mortgage rates were extremely low. Many are sitting on 2 to 3% interest rates. Selling their home now would mean giving up that low rate and taking on a much higher monthly payment. Prices from dropping the way people expect. True housing crash usually requires forced selling, foreclosures, job losses, or widespread financial distress. But today, most homeowners are not under pressure the way they were in previous crashes. Lending standards have been tighter for years. Homeowners have more equity. Risky adjustable-rate mortgages are far less common. That means fewer people are forced to sell at a loss, which removes another key ingredient needed for a crash. Housing is not a completely free market. Government policy plays a major role, from interest rates to lending rules to housing incentives. Recent policy signals clearly suggest stabilization, not collapse. Whether it's protecting homeowners, supporting financial institutions, or controlling systemic risk, the goal is to avoid a sudden drop that could damage the broader economy. That support effectively creates a floor under housing prices. High interest rates absolutely reduce buying power, and there's no denying that. But instead of crashing prices, what they've mostly done is freeze the market. Fewer buyers, fewer sellers, and far fewer transactions. Prices don't fall rapidly in frozen markets. Instead, they move slowly, stagnate, or adjust unevenly. Some areas cool slightly, others hold steady, and a few continue rising due to local demand. One of the biggest mistakes people make is treating the housing market like a single national story. Housing is local. Some cities and regions may see price drops. especially where supply increased or demand weakened. Other regions with strong job growth, migration, and limited land may remain expensive for years. A nationwide crash requires nationwide distress, and that simply isn't happening right now. Demographics also play a huge role. The largest generation in American history is entering peak home buying years. Even with affordability challenges, this group still needs homes for families, stability, and long-term security. That underlying demand doesn't disappear just because rates go up. It gets delayed, not destroyed, and delayed demand often returns when conditions improve. Inflation adds another layer to this story. While it hurts affordability in the short term, it also increases the value of real assets like housing over time. Construction costs rise, land becomes more expensive, and wages eventually follow. This creates long-term support for housing prices. In inflationary environments, prices often stay elevated rather than collapsing. Comparisons to past housing crashes, especially 2008, often miss the bigger picture. Back then, the market was built on risky lending, speculation, and massive overbuilding. Today's market is the opposite. Undersupplied, more regulated, and supported by stronger homeowner balance sheets. The structure is fundamentally different, which is why the outcome is different. For buyers waiting on the sidelines hoping for a massive crash, the reality may be uncomfortable, than waiting for a collapse that may not come. For sellers, this market is unusual but not necessarily bad. While bidding wars are less common, limited supply still gives sellers leverage, especially in desirable locations. Pricing accurately matters more than ever. Homes don't sell instantly at any price anymore, but the downside risk remains limited. Investors also need to adjust expectations. Rapid price appreciation may slow, but long-term fundamentals remain strong in many markets. Rental demand remains high, ownership remains difficult, and housing continues to be a core asset in the American economy. This is not a boom or bust phase. It's a slow recalibration. Much of the confusion around housing comes from headlines designed to grab attention. Words like crash and collapse drive clicks and views. But reality is more complex and far less dramatic. Housing markets usually don't implode overnight unless something breaks at the foundation. And right now the system is strained but not broken. The most likely outcome is not a dramatic crash, but a long period of sideways movement. Prices may flatten, some markets may cool, and affordability may slowly improve through income growth and future rate changes rather than falling home values. This frustrates buyers, but protects the broader economy. The U.S. housing market is sending a clear message. It is no longer following old rules. Limited supply, locked-in homeowners, demographic demand, and policy support have rewritten the playbook. If you found this analysis useful, don't forget to like the video, subscribe to the channel for more deep, data-driven content, and turn on notifications so you don't miss what's coming next.